So on a very, very solemn Saturday morning, Larry Goldberg is with us. And Larry, let's just start off. I've indicated to you my prayers are already out with regard to Israel. Of course, I'm a staunch supporter of Israel. I know you have family there. What are your thoughts this morning?
Yeah, we do have family. They're very close family, and quite a lot of family. In fact, my granddaughter of 13 was just over there for during the summer for a 3-week visit, and thankfully she's home now. But and our family are not endangered currently because they're not close to the Gaza Strip. This is to me, this is a moment that indicates the power of the newfound power of Iran with this alignment they're forming with the Saudis, but this very close relationship they've developed with Russia. And now Iran has got a lot of leverage over Russia, being their principal weapon supplier. So, this is Iran and Russia supporting the extremists in the Gaza Strip. I mean, this war will end badly for them, but it'll cost Israel a lot of lives. It'll cause a lot of death and destruction. The early reports are that civilians have been indiscriminately killed in Israel, and I certainly understand the Palestinians' views on this, because Palestinian civilians have always been in the firing line and have been killed in these Gaza wars, and now it's come to Israel. So for Israel, this is a very tough time. The war will end very badly for the Palestinians. They will win a moral victory because they've definitely turned the tables on the Israelis. They've really given the Israelis a terrible shock. Israel has been very introspective in the last couple of months, since the last election, yes, because of the protests and so on and so forth. This is going to be a wake-up call for Israel too. So it's a bad situation. I don't see any real good coming out of it. And there's no doubt in my mind at all that Ukraine figures very heavily in this, because I think Russia helped promote this because of their client relationship now with Iran. I think the visit by Hamas to Russia should have been a red flag for the Israelis. They apparently didn't pay attention. I didn't, so I can't blame them. So in summary, it's not a great situation. It's going to end badly for the people of the Gaza Strip. It has been bad for the people of Israel. Like all these wars that have been fought over the last 20 years, 30 years, since the state of Israel, it's not going to be good for any of them. So
75 years. It's easy for me to remember. Israel was born in my birth year. So
yeah, so, it was born 2 years before, or 2 years after my birth year.
Yes, making you, as always, older than me. Yeah.
I always seem to end up at the wrong end of this conversation.
So Larry, we get together on this Saturday morning after the employment numbers come in to talk about Cathie Wood's analysis of the numbers. And my first thought was that anybody that hasn't seen the Cathie Wood report from last night should go look at it. It was, in my opinion, her best ever. Very comprehensive, very interesting, lots of data points that I had not thought of or looked into. So what about you? What did you think?
I thought it was fantastic. I can summarize it if you like, or
That'd be
we can just.
wonderful. That'd be great.
Okay, so her conclusions are that we're in a rolling recession, and this is not new for her. This is confirming everything she said. She said it started about 18 months ago. We've had 2 consecutive quarters negative. She calls it a rolling recession because we're having recession in different segments of the economy over this period of 2 years. So it hasn't been the whole economy all at once down together, but there have been different elements of it. Housing has been down, very badly. We're almost down to the 2008 numbers, by the way. That's how bad it is.
Of the number of houses sold.
Sold, yeah.
Now there's I always, so I recognize that it doesn't matter why something happens, it's still recessionary. But the housing market being down right now has absolutely nothing to do with the lack of demand. It has everything to do with the fact that people are stuck in mortgages between 2.5% and 3.5%.
When you're dead, you don't actually question the cause. Dead is dead.
Yeah.
When the market is down, it's easy to say, well, it's only down because of this reason or that reason, but it's down. And so that economic activity ceases and the impact is the same.
Money doesn't change hands, products don't change hands. That therefore is by definition a recession in housing. And the same thing with auto.
And the second, I was going to touch on the auto, because people think that because sales are up year on year, everything's fine, everything's rosy. No, it's not. Our auto sales are at recessionary levels. Yes, they're higher than last year. Yes, prices are up, but they're down at recessionary levels.
Yep.
And dealer lots are still full. So it's not good. I mean, we are well below par. We'll hit 15, maybe 0.5 million this year, but it's recession level. Our government is in gridlock. I mean, you could not make a worse scenario for a government stasis in a recession than they figured out how to get themselves into this lock. You couldn't make it up. If you wanted the worst possible government structure in the time of recession, this is the structure you would ask for. And we're going into election year, and so we don't see this gridlock improving. And in fact, we think the government, this is my personal opinion, it's not Cathie's, but I think the government's going to default this year. I think for the first time since actually the reunion was formed, we're going to default.
So this would be because in 45 or 40 days, whatever's left before Thanksgiving, the two sides will not be able to come together on a continuing resolution and or a final resolution. So therefore we will, and that won't last a week or a month. It'll last into the new year, and therefore we will not be able to pay off bonds that are becoming due.
We won't be able to pay the interest on bonds.
Won't even be able to pay the interest on bonds, right?
That first, before we even have to pay bonds that are due. Actually, I'm not that certain which is first, but both. You can roll over a bond, but if your customer doesn't want to roll it over, you've defaulted.
Yeah.
So and then inventories. Many are saying that inventories are dropping dramatically at the retail level, but inventory in the Q2 numbers show change from negative to positive. We haven't seen inventory slip to negative, but imports are dropping at double-digit rates.
Yeah. So this is more of Cathie's information that I was shocked by.
Yeah.
I was not paying any attention to those import numbers. I was also not. Now she says she has it only by her conversations with folks out there that the inventories at retail, and I don't know if she has information about wholesale, but that these inventories will be down. Now, on the one hand, inventories being down can be looked at as recessionary in that you or I, when we owned our businesses, we would have reduced inventories in anticipation of lower sales. But it could also be be extremely positive, because that means that orders will need to be placed. You can only reduce the inventory so far.
Well, being as my business is primarily in the software business, I had infinite inventory.
Right.
But yes, you're right. I mean, inventory is a very strong bellwether, but the reduction in imports could well be also this replacement program, onshoring.
Yes.
So that could have an effect. It could have a very large effect, particularly on capital goods. I wouldn't have thought it happened as quickly as this. So I think that it is indicative of dramatically slowing, economic activity. Now, then she also adds that the rest of the world are much worse than us. We're in a rolling recession. Many economies in the rest of the world are in a real recession.
In particular, China and some parts of Europe, Germany and England, maybe.
Germany's in severe recession, actually. China is in recession, and this has a lot of consequences, and we'll deal with that in just a little bit. But she points to GDP versus GDI growth. And a lot of people confused by what is GDP versus GDI. GDI is very easy. It's everybody's income added together. GDP is everybody's expenditures added together. It's as simple as that. Now, the two should equal, because income and expenditure, should balance. That's how balance sheets work. But they're not balancing. GDI is down significantly, while GDP is showing, 2% up. So this indicates that firstly, GDP is estimated numbers. GDI is really quite an accurate number because it comes from real returns.
Right.
So I think, and that's flat, by the way, not down, it's flat. So the question is that sluggishness real? Yes, I think it is. And does that sluggishness indicate a recession? Barely, but it certainly doesn't show growth.
So, Larry, I did a YouTube video the other day where I went into a very, very deep analysis of previous recessions. And I actually learned some new stuff myself while I was doing the research. We have not, in 40 years, we have not had a recession that has been Fed caused or inflation caused. So we have to go back to the 80s to get to where the Fed or inflation was at the root of what was taking place. The government was a problem, but not the Fed itself.
I agree.
Okay. And so that's a very, very long time for those two issues not to have been the reason for a recession.
Well, hold on 1 second. That triggers something in my head.
All right.
2008. I think Fed was a contributor to that recession.
Well, they might have contributed, but the real issue was derivatives. I mean, at the end of the day, it was all
derivatives are a direct outcome of Fed policies, in my judgment.
Okay. So
I think the Fed opening the spigot leads to derivative action. I think the Fed should have clamped down earlier and stronger. And I think that and maybe it's not a direct cause, but I think it has a lot to do with it. I mean, the Fed, after all, is responsible for the quality of the bank's assets. Ultimately, they hold the bank's responsible, right, but they police it, right?
Right.
And so the reason, that the Fed has become so much more intrusive in the bank's activities is because they fail to see the quality of the bank's assets at those dates that the banks were holding.
Right. But then again, one could make the argument that the reason that those derivative assets were so poorly understood is because of the housing authorities in Washington, D.C. were not adequately taking a look at the underlying assets, and that the assets were nowhere near the value that.
Well, that's not the housing authority's responsibility. It's actually the Fed's responsibility.
Is it?
It's financial responsibility.
Even on the derivatives.
Yeah. I mean, the derivatives on the books of the banks and the insurance companies are the responsibility of the bank and the insurance authorities. So they're the regulators are responsible to ensure that those assets are of a certain quality. And both regulators, in the insurance case, it's state regulators, but in the bank's case, it is definitely the Reserve Bank and the FDIC together. Well, not really the FDIC, because it's actually the Reserve Bank. I mean, they should have spotted the problems with the derivatives much, much, much earlier, in my judgment.
Okay,
could be wrong.
So we're way off track here. Let's get back to Cathie Wood's analysis. So anyway, my point was only that your issue, I think, and this has been your consistent issue, and I don't disagree with you, by the way, is that what we may be getting into right now is that there's not enough lending available. There's not enough cash available. The money supply, M2, has been going down rapidly. And while there was a lot of money to begin with, so you could have a fairly substantial sell-off in terms of the total dollars in circulation, you can get to a place where there isn't enough, and especially where there isn't enough that's lendable. And therefore, you would have lots and lots of companies, utilities, et cetera, who would not be able to borrow. If they can't borrow, or they can't borrow at rates that they can live, that they can continue to exist as an organization, then they go bankrupt. And we do see small business bankruptcies going up, as well as mid-market bankruptcies going up pretty dramatically.
Right, and then we have to look at employment. So as Cathie said, that the report was very strong with upward revisions. It's a surprise. It's the first time after many downward revisions. But she challenges that because the household surveys suggest that employment growth is only 86,000. Now, that may reflect, she says, small business, but still, there's a very big gap between, what is reported and what is being seen by these surveys. So, there's a big question about this, and she raised that question because if, in fact, employment is that strong, then her thesis is wrong.
Yes, I think that this is one place where Cathie missed yesterday. I am shocked she's not watching my videos because later in the day on Friday, the market, of course, reversed by 700 points. And I'm like, what's going on? So I start digging, and a lot of other people were digging too. And it became evident as to why the market turned around like it did. Number one was they, of course, concentrated on the 2%, the 0.2% month over month wage increase, which is what the Fed is going to care about more than anything else. But the other thing, when you dig into it, is that these jobs were all part-time. These were all second jobs. These were not new employees coming into the market. In fact, there was a reduction in the total number of full-time jobs over that period.
That's a very good observation.
So I'm surprised Cathie didn't catch that or see that from some of the people that were reporting on that, because that's massive. It explained why there was only 90,000 new people in the labor market. Basically,
interesting.
Yeah,
that's very valuable information because that confirms her thesis in general.
Yes, it does. Absolutely confirms.
It doesn't confirm yours, though.
Well, one thing it confirms, you have to understand, for me, my thesis that we're never going to be in a recession. Well, okay. Somebody really, really was unhappy with me the other day because I said something about recessions. I said, well, the recession 18 months ago didn't feel like a recession. And boy, somebody let me have it on that one. Well, okay, but I think economics has a lot to do. Understanding economies. If you listen to economic experts, the ones that actually have PhDs, they commonly are feeling their way into what the economic circumstances are. I have not felt in this entire 2 years. I haven't felt like we were in a recession. I have felt like we are in a correction of a really bad situation, and that the correction was definitely scrambling things. But he didn't like, what did somebody call it? The real definition of a recession is not when my neighbor loses his job, it's when I lose my job. But my neighbor hasn't even lost his job yet.
Yeah. So that's why Cathie calls it a rolling recession, because it's not evident to you or me or to you on a given day, but it's evident to your neighbor on a given day. And whether a rolling recession counts as a recession is an open question, but she definitely says, and I think it's going to be adjudged a recession in the future. By the way, enable sharing, because I do want to show one slide that she showed. I'm going to not show all the slides, but I'm going to show this one slide.
Yeah, just a second, Larry. I just completely blew it here. Completely did it wrong. As usual. I don't know why I have such trouble with sharing. All right, I have just enabled for you.
All right, so what I want to do is show you this slide because it's very interesting. Oil prices are a very big component, or oil price rise has been a very big component of inflation.
Yes.
Such as we've had. Do you see my slide now?
I do see your slide, and I have said for my entire adult life that oil is really currency. So, you know, it is so much of a part of this entire structure of everything that we do that you could almost call oil another currency.
Well, oil is priced in dollars.
Right.
And dollars is the world currency. Right. And oil is a huge component of total global spend.
Right.
It's not huge in terms of, 50% or anything like that, but it is, I think, the single largest commodity traded, and therefore it's the single largest spend of any particular component. And so what's important about this slide, and what Cathie made the point of, is that there's a very significant disconnect between the crude oil price, which is the line at the top, which I'll show you with a marker. Should be clear. It's this line here, versus US gasoline prices. US gasoline prices are dropping very dramatically, far faster than oil is dropping. I don't know if it's settling down now, but I actually saw that drop as I traveled through the States. Every successive place I stopped, the gasoline price seemed to tick down a penny or two. And so the point that she's making is that, this is not an inflationary indicator. This is an anti-inflationary indicator.
Yes.
So I think there's something real in what she's saying. I think,
and I think here too. I reported on this last week. Took a deep dive into this as well. And what you're seeing, first of all, you have a 25-year low in the use of gasoline in the United States.
Right.
This is huge. Then you have recessions, as you point out, in parts of Europe and in China. And of course, that's going to reduce the amount of gasoline that's being used. You also have large amounts of inventory in the United States of gasoline right now. There is no inventory problem. In fact, refineries are going to be looking for places to put it pretty soon because there's just so much of it right now. And so you have all of those factors. And then about a month ago, I reported in depth that you have the United States already increased, and Cathie reported on this, the United States increasing their record output right now. Canada, record output right now. You've got the 5 non-aligned OPEC countries, Iran, Iraq, Venezuela, Syria, and I forget the fifth one. Those 5, they call them the hungry oil companies because they can't afford not to produce as much as they possibly can and sell as much as they possibly can. And you have the United States turning a blind eye on Venezuela and Syrian and Iranian shipments. So to the extent that that Saudi Arabia has tried to reduce the overall supply in the world, might have been a reaction to them knowing all of this in advance and going, oh my gosh, if we don't reduce, the price is really going to drop like a rock. So anyway, that's a very high likelihood right now, in my opinion, that we'll continue to see oil drop as it did like crazy over the last week. We may see this continue back down into the 67, 68 range.
I think that's a reach. I don't think it's going to drop that far. I mean, right now, the gasoline producers, the refiners, must be losing their boots. It's going to be very, very tough for them. I think, I think they're going to respond to this. I think, and it's interesting because, we've just seen a spike in actual output of crude oil. These guys always get caught. They swear this time is different. They swear they're not going to start drilling again, and they haven't really started drilling again.
Oh.
But they're still going to get caught short because some of them are buying significantly. I mean, Warren Buffett spent an enormous amount of money buying oil producers, oil refiners in the last year. He bought, is it Occidental?
Yeah.
I wonder if he's going to live to regret it in the short term.
Will live to regret it is the question. Yeah.
Yeah, I think Berkshire can weather it, but it can be very, very brutal. I've seen it happen, and it can be very, very brutal. I wouldn't be surprised to see a 30% drop in gasoline prices, maybe a 40% drop in gasoline prices from this level.
Yes.
And so, we'll see what happens.
Of course, all of those things are, of course, deflationary, at least, or disinflationary, whatever the word is they're using now, or it could be absolutely deflationary, combined with the other things like rent being at zero. Cathie says we're heading for deflation. Costco says we're heading for deflation. And I think Costco has a really good ear to the ground. They're saying that they're cutting prices everywhere and that they see deflation in the future. So I'm trying to figure out where the inflationary pressures continue to exist. We see them primarily at this point. Things that are still around 4% would be some services. But a lot of that has to do with airlines, and airlines, if the price of oil goes down, then the price of tickets can go down. I don't know. I don't know where the inflation.
Well, the ticket price could be impacted by demand if demand continues at this very, very high level. Right. So that's really, there are two sides to the pricing, algorithm. So, getting back to Cathie, then she talks about average hourly earning index is up 4.2%, 0.2% month on month. That's pretty high. That represents, dropping unemployment or, employment demand. I think people still haven't returned to work. A lot of people still haven't returned to work. And, it's really bothersome, but that's how it is. And then, she talked about the inverted yield curve. It's been an inverted yield curve for more than 2 years now.
I thought, Larry, not to correct you, but I think it goes back to July of last year. So 15 months is where the inversion started.
Yeah, more than a year now. Yeah,
right,
that's
more than a year.
Sorry,
and some people make the claim, not that I do, I'm just saying that there's this other side to it, that inversion really started in October, because up until October, you might have had the 2-year and the 10-year inverted, but the 2-month and the 3-month still weren't inverted. Anyway, just to not to put too fine of a but anyway,
Well,
in any case,
you may be right, but I'm going to share one more slide for you.
Absolutely.
Which is this one here. And so this this shows you the term premium on a 10-year zero coupon bond. Now, you'll see it's actually spiking up.
Yes.
Why is it spiking up? And by the way, it's doubled in a week.
Yeah.
A week ago, it was half of this. Now it was 0.1. Now it's 0.2. Now it's real. A week ago, it was kind of, almost could be ignored. Right now, it's 0.2. This is a very significant premium. Premiums like this don't happen, out of the blue.
No, let's make sure that people understand what this is, Larry. This is the real interest rate over and above the spread between inflation and interest rates.
That's right.
Okay.
You'd expect to earn 2.5% on a 10-year bond, everything else being equal, inflation being 0. But now you're earning 0.2% above the inflation rate plus the what is considered to be the neutral rate.
Right.
And it's spiking.
Right.
Okay. This is not a good indicator. This is not your fair weather friend, Randy.
So, of course, my opinion is that this will do just what oil did. So this is out over its skis. This cannot be maintained. And we will see once the inflation numbers come in, maybe even before the inflation numbers come in, but when the CPI and PPI come in this week, that people will start to go, okay, trueflation is correct. And they'll look at the gas prices going down, oil prices going down. Everybody knows the rents are flat. I mean, this is not, the Fed has even acknowledged that rents are flat. Housing, the housing prices, residential real estate is going up slightly, but it's not going up at significant numbers at this point. So I think at some point the bonds have to respond.
You may be right, and you could be right, because that's one good explanation. There's another good explanation. That there's severe risk of default.
Oh, okay.
There's a rising risk of default. So your explanation is the bond yield is wrong. I'm right. It's going to fix itself. Okay. But the bond yield is the bond yield. It seems it has the smarts of the market.
Yes.
And it's spiking for one of two reasons. Either inflation's going up, or risk is going up. I mean, one of the two things are happening.
Mm-hmm.
And so, Al Arian, who knows a little bit about bonds, says credit default swaps are gapping out again.
Yep.
That's the same as this problem here. Something is going to break again, he says.
Right.
He says the bank crisis is not over. This could be an indication of it. And while, this great picture you paint may be true, it may come to a screeching halt if the banks break.
Yeah. Yeah. Well, again, now this would be my biggest concern, continues to be my biggest concern is, will there be enough lending to make sure? So my hope is, and this is hopium, 100% hopium, because I don't have any data to back it up. I do have individuals who I respect who have said this is true. There is a lot of money in the hands of consumers, in the hands of businesses, and that money is a buffer on all this. So where in a normal situation, companies might have been borrowing their brains out in order to maximize their opportunities. They've been expecting a recession now for 2 years. So a smart business would have reserves. They would not be borrowing at those levels. They would have made some decisions in advance based on a recession coming. They would have read my book on recessions, Larry, where it says, get cash, hoard cash, find ways. Now, that doesn't mean that there won't be still be something in the, that there won't be some stupid companies who were borrowing to the max and can't afford to go from a 5% or 6% loan to a 9% loan, and that they might be really, really in trouble. But I think it'll be buffered by the fact that I think that there's a lot of cash on the sidelines.
By the way, this is the slide that I created because Cathie actually had a slide from a previous time where she showed only the point one, no, this is create a default swap, sorry. Well, no, she didn't show it. I don't have it. But by the way, look at what's happening to create a default swap.
Oh, that's a scary one. That's the Halloween slide right there, Larry.
But you know, this is the Halloween slide because this is really reflective of this. Oh, sorry, let me start again. This is the cause, or this is the same symptom as that.
Yes. Yes.
So, you know, there's a lot of reason to be, no, you have found a lot of reason to be optimistic.
Of course I have.
But there are some problems out there. Now, Cathie is of the opinion that innovation and productivity is going to drive us out of this thing over time.
Yes.
And that in hard times, innovation gains traction.
Yes.
And as this rolling recession intensifies, that's going to be the solution. And AI is rapidly coming to our defense.
Yes.
Yeah. You know, I heard that as well during the in 1999, in June of 1999, when, you know, and I sold my company on that date.
Nice.
Why? Because I had a slightly different feeling in my water than, you know, you have right now about this economy. I think the government has
overcorrected.
Yeah, they've overplayed their hand is actually what I really believe. They've overdone it on several fronts. And, you know, they control both sides of this. They do all the regulation, but they also supply the tap. So, you know, it's kind of, it's a bad situation when you've got the same guy turning on the tap and turning off the tap, but also applying the regulation.
Yes, yes.
So I'm really concerned about the situation right now, and more concerned than Cathie, and more concerned, of course, a lot more concerned than you.
Well, so there was another, I thought there was another interesting element to this inflationary issue too, and that was one of the biggest spikes in inflation during the last 3 years, was all new cars and used cars.
Yes.
Now, we know that used car inflation is already coming down. New car inflation may be coming down. But what we do know is that Elon just jacked up just added to the war, so-called, in the United States by reducing the prices of the 3 and the Y by a couple of grand. I had this crazy idea this morning as I was contemplating our conversation, Larry. Do you think that this was an unnecessary drop in price by Elon to really skewer ICE cars during the during this what do you call it, during the UAW strike? Could this have been strategic?
I mean, Cathie makes the point, and this was during her in the know conversation, that all he's doing is returning the price of the car to where it was 2 years ago.
But there has been a lot of inflation in that 2 years.
Well, you know, there has been inflation, but there's been an enormous amount of engineering to take out cost.
Yep.
The question is, and by the way, you know, the margins that Tesla reported were probably in excess of the margins that they wanted to earn. Now, you know, Gary is making a very strong point. Gary Black is making a very strong point, and it's echoed by many and supported by many, that it's one thing to reduce prices for whatever the strategic reason, but not to take advantage of it by getting the information out broadly through advertising and marketing is kind of defeating the purpose of the action.
Yeah, no, listen, I have been over a year ago, before the first reductions, I said, if don't reduce the prices, advertise, market. There's so many different ways, put out entire videos on the different ways that Tesla could advertise and market. But here's my but. I think I just put a video on this, put content on this late yesterday. Maybe I haven't put a video on this yet. The head of not CATL, LG
batteries, yeah.
CEO of LG says he confirmed yesterday afternoon that there's a huge glut on batteries. Some of the other folks have talked about the 33% reduction.
Is the head of LG or the LG battery company?
This is the battery division, the CEO of the battery of the energy division. And he says that there's a huge glut. Other people have said the drop in price has been 33%. He didn't give an exact number, but he says it would be, it's expected that the BEV companies would be asking for reductions, would be getting reductions right now. So I figured out that if the reduction is what people think it is, it would have been about $30 a kilowatt hour. Multiply that times 65 kilowatt hours, you've got $2,000 in cost coming out of the car. If you have $2,000 in costs coming out of the car, you can reduce the price a lot.
Yeah, but let's stipulate that the cost has come down.
Yeah.
Let's stipulate that the margins remain above the 18, or certainly above the 15%, possibly as high as 18, but above the 15%, which is the Toyota margin, which is the kind of loads. I mean, it has been the target of the, and of course, none of the US auto OEMs have ever remotely approached it, but certainly Toyota is there, and maybe some of the, maybe some of the others. I know that the Chinese are not even remotely close to it. I mean, everybody says BYD, BYD, BYD. The last quarter, BYD earned the princely sum of $500 million on sales that exceeded, you know, Tesla's by a significant amount. Anyway, dollar sales. The bottom line I'm saying is that it's one thing to maintain prices at a stable level, or to reduce prices to get them down to a stable level. But let's stipulate also that Tesla have got a couple of models of cars. They've got 4 models, but really only 2 volume models of cars. The total addressable market of which they've already shot their bolt on.
Well, really?
Yeah, because look at it this way: the model, the X is already selling more than the Corolla.
I'm sorry, you're talking about the Y. The Y.
The Model Y, XYZ. The Model Y is already selling more than the Corolla. Now, that's not entirely true. It's already selling more than, you know, the sort of flagship Corolla. But Corolla's got multiple different.
Right. Dozens. Okay.
But the bottom line is they are way beyond their reasonable TAM, for their reasonable share of the TAM of that model of car, or that category of car.
Under the old way of thinking, Larry, but they're only at like the number of cars that they're selling in Missouri is almost negligible. The number of cars, the number of cars that the number of cars that they're selling in Spain is negligible compared to what they're selling in the Netherlands.
But that supports Gary's point.
Okay.
That if you're going to change people's whole approach to how they buy a car or what kind of car they buy, you're going to have to enlighten them as to what their options are.
Well, listen, I'm with you, Larry. I'm not against you. I think he could have done both. I think there's plenty of money. I think there's plenty of money to do both, and I don't think there's any, I don't think there's any compelling reason not to at least try a significant advertising effort. He has a genetic, it's in his DNA that he doesn't want to, but I don't think that is necessarily wise over the long.
And you know what drives it?
Go ahead.
Cost consciousness.
Mm-hmm.
You know, if you compare the R&D of Tesla to almost any other technology company or auto company, they have the lowest rate of spend on R&D of any of those companies.
Yep. As a percentage of sales.
Yeah.
Yeah. And yet the output
and almost at an absolute level, because their sales are generally smaller. So it's ridiculous. They spend nothing. And so Elon cannot bring himself to spend money on something that he knows at least 50% of it is a waste of money.
Right. Yes, 50% of all advertising is wasted. If we only knew which 50% is the saw of everybody in marketing.
and that's why he won't spend it. He just won't spend it. He's incapable of spending it. So what we lose on the swings, we gain on the roundabout. Because figure it out this way. Let's assume he were to spend $1 billion a year on, or $1 billion a quarter on advertising, and that lifted his sales by $5 billion.
Yeah.
His margin on that would be about $1 billion, almost $1 billion, right?
Yep.
Yeah. I mean, it's, but, and here's the huge, I mean, if he doesn't spend it,
we don't know.
I mean, it's kind of a very, well, maybe I'm wrong on my math, because truly speaking, well, actually, if you look at BYD, I mean, they earn a reasonable margin, 12, 13% margin, which is not only reasonable, it's actually very good.
Right.
But their actual profits are like paper thin.
Right.
Paper thin. Where's the money going?
Well, apparently overhead. Yeah. So, all right. But I think getting back to the Cathie Wood analysis, if Tesla drops the price by $2,000 on their number one and number two selling cars in the world, basically, I mean, or number one for sure, and the Model 3 is getting very close and could easily become the number two best selling car in the world. If he's dropping those prices, that is going to impact Stellantis and GM and Ford and BYD and everybody else. I mean, they are all going to, well, BYD is not in the United States, but all the US sellers are going to have to look at that and decide whether they're going to match it, and not just on BEV electric vehicles, because that's a very small percentage of for all the rest of these companies, but on their ICE cars as well. These prices are now near parity. In fact, I could make a strong argument that you're getting way more vehicle on a Model Y or 3 than you are on similarly priced cars.
But your argument fails if Tesla is unable to get the word out on those prices.
Well, so at some point the word gets out. Okay, I mean, this would be his point of view, and I agree that the number one by far has always been, as a marketer, word of mouth is clearly the best way to get the word out. There's no doubt about that. And if your neighbor is saying to you, in fact, I just said this to somebody the other day. They said, well, I just bought this used Jeep or whatever for 22,000. I said, do you know you could have bought a new Model 3 for 27? And he goes, what? You know, it doesn't take too many of those conversations before people are like, oh, wow, holy mackerel.
Well, the problem is that people are also intimidated about the charging issue, about the fires issue, all of that. So I think it takes more work than just discovering that the price is good.
All right. So, but anyway, let's go back to Cathie. We keep getting
Yeah.
off on the marketing side. Cathie says, if auto retails go down, if that's disinflationary or even deflationary, that is a huge percentage of the GDP is auto sales. That would just be one more element that would be reducing the inflation rate. And you know,
But also reducing the growth rate.
and also reducing the growth rate. That's true, which is always the problem, right? Yeah. So deflation.
Well, the bottom line is Cathie believes we're in a rolling recession. She's looking for innovation to get us the way out of it. And our good friend Randy believes that we're in this beautiful growth mode and everything's perfect.
So I'm kind of a little less than that. So I believe that there is no other than cash, which is my big worry. Other than cash in the system, I don't think there's any other reason to think we would go into I mean, sure, we could have a George Bush the first 1991 recession that lasts for less than 6 months, and that is like the one that we had last year that nobody even pays attention to. Yeah, that could happen, but I even don't see that unless there's another. There can always be the surprise. You know, there's always shocks.
I see this recession persisting. I see it persisting as long as the money supply continues at this doleful rate. And I think that there will be limited recovery sector by sector. Right. That's what I think.
Right. All right. Well, I think Cathie again hit it out of the park. So those of you who have not watched her entire video, it's one of the longest ones too. I think she's usually around a half an hour. This time it was almost an hour. And we've just spent an hour taking it apart, putting it back together again, and giving you our wisdom, sharing with you our combined 150 years of wisdom, 152. Somebody was going to correct me on that. I know they were, Larry.
Yeah.
So thank you, Larry, on this. I know we are at the end of the day today, very interested in what's happening in the world economy, but most of all, we got Israel on our hearts, and our thoughts, prayers, and hopes for a quick resolution to this particular conflict. That's what we're hoping for. Larry, thank you so much for coming on this morning.
Thank you, Randy.
And for all of you out there, it's been great talking to you.